Hello guys, welcome back to my channel. Today we are going to talk about beta. What is beta? Beta B is a measure of the volatility or systematic risk of a security or portfolio compared to the market as a whole, usually the S&P 500 stocks with beta higher than 1.0 can be interpreted as more volatile than S&P 500. Beta is used in the capital asset of pricing model CAPM, which describes the relationship between risk and expected returns of the assets. Usually, stocks CAPM is widely used as a method for pricing risky securities and for generating estimates of the unexpected return of assets, considering both the risk of them assets and the cost of a capital. How beta works. A beta coefficient can measure the volatility of an individual stock compared to the systematic risk of the entire market. In statistical terms, beta represents the slope of the line through a regression of data points. In finance, each of these data points represent an individual stock's returns against those of the market as a whole. Beta effectively describes the activity of a security's return as it responds to swings in the market. A security's beta is calculated by dividing the products of the covariance of the security's returns and the market's returns by the variance of the market's returns over a specified period. The calculation for beta is as follows: beta coefficient is equals to covariance RA3 by Rn square variance R square beta confident P, where R is squared the return on an individual stock and Rm is equals to the return of the overall market. And covariance, how changes in a stock returns are related to changes in the market's returns. Variance is equal to how far the market's data points spread out from their average value. This beta calculations is used to help investors understand whether stock moves in the same direction as the rest of the market. It also provides insights in how volatile or how risky a stock is relative to the rest of the market. For beta to provide any useful insight, the market that is used as a benchmark should be related to the stock. For example, calculating a bond ETF's beta using the S&P 500 and the benchmark would not provide much helpful insight for an investor because both bonds and stocks are too dissimilar. Understanding beta. Ultimately, an investor is using beta to try to gauge how much risk a stock is adding to a portfolio. While a stock that deviates every little from the market doesn't add a lot of risk in a portfolio, it also doesn't increase the potential for greater returns. In order to make sure that is a specific stock is being compared to the right benchmark, it should have high R squared value in relation to the benchmark. R squared in a statistical measure that shows the percentage of securities historical price movements that can be explained by movements in the benchmark index. When using beta to determine the degree of systematic risk, a security with a high R squared value in relation to its benchmark could indicate a more relevant benchmark. For example, a gold exchange traded fund ETF such as the SPDR Gold Shares GLD is tied to the performance of gold bullion. Consequently, a gold ETF would have a low beta and R squared relationship with the S&P 500. One day for a stock investor to think about risk is to split it into the two categories. The first category is called systematic risk, which is the risk of entire market declining. The financial crisis in 2008 is an example of a systematic risk event. No amount of diversification could have prevented investors from losing value in the stock portfolios. Systematic risk is also known as undiversifiable risk. Unsystematic risk is also known as diversifiable risk, is the uncertainty associated with an individual stock or industry. For example, the surprise announcement that the company Lumber Liquiders had been selling hardcore flooring with dangerous levels of formaldehyde in 2015 is an example of unsystematic risk. It was risk that was specific to that company, and systematic risk can be partially mitigated through diversifications. Types of beta values. Beta value equals to 1.0. If a stock as a beta of 1.0, it indicates that its price activity is strongly correlated with the market. A stock with a beta of 1.0 has systematic risk. However, the beta calculation can't detect any unsystematic risk. Adding a stock to a portfolio with a beta of 1.0 doesn't add any risk to the portfolio, but it also doesn't increase the likelihood that the portfolio will provide an excess return. Beta value less than 1. A beta value that is less than 1 means that the security is theoretically less volatile than the market, including the stock in a portfolio makes it less risky than the same portfolio without the stock. For example, utility stocks often have a low beta because they tend to move more slowly than market averages. Beta value greater than 1. A beta that is greater than 1 indicates that the security price is theoretically more volatile in the market. For example, if a stock's beta is 1.2, it is assumed to be 20% more volatile than the market. Technology stocks and the small cap stocks tend to have higher betas than the market benchmark. This indicates that adding the stock to a portfolio will increase the portfolio's risk but may also increase its unexpected return. Negative beta value. Some stocks have negative beats. A beta of 1 means that the stock is inversely correlated to the market benchmark on a one-on-one basis. The stock could be thought of as an opposite mirror image of the benchmark's trend. But options and inverse ETFs are designed to have negative betas. There are also a few industry groups like gold miners where a negative beta is also known as beta in theory versus beta in practice. The beta coefficient theory assumes that the stock returns are normally distributed from a statistical perspective. However, financial markets are prone to large surprises. In reality, the returns aren't always normal distributed. Therefore, what a stock's beta might predict about a stock's future movement isn't always true. A stock with a very low beta could have a smaller price swings, yet it could still be in a long-term downtrend. So adding a downtrending stock with a low beta increases risk in a portfolio only if the investors define risk strictly in terms of volatility. From a practical perspective, a low beta stock that experiencing a downtrend isn't likely to improve a portfolio's performance. Similarly, the a high beta stock that is volatile in a most upward direction will increase the risk of a portfolio, but it may add gains as well. It's recommended that investors using beta to evaluate a stock also evaluate it from another perspective, such as fundamental or technical factors, before assuming it will add or remove risk from a portfolio. So this is it for today, guys, for what is beta and is beta related to cryptocurrency. I will see you in the next video. Thanks for watching.